Mhm.
Silver is incredibly volatile, both to the upside and the downside. It's the upside that comes next. As to a squeeze, I think the squeeze comes about, if it comes about, because the trading volume in the futures market is so extraordinary relative to the amount of gold available for good delivery in the physicals market. Many days, single days, the trading market trades 200 times the amount of silver
Mhm.
available for good delivery on the market. The potential for a fairly small number of the futures contracts to hold for delivery and the impact of what that would have on physically available supply could be dramatic.
Silver has long been considered gold's shadow in the precious metals market, but that's changing fast. According to veteran investor Rick Rule, silver could be entering one of the biggest bull runs in history. While gold has held strong, silver has quietly surged more than 28% this year, making it the best-performing commodity. This rally is fueled by record industrial demand, 7 straight years of supply deficits, and growing investor interest. Rule sees the potential for a silver squeeze, as both industry and investors compete for limited physical supply, especially given that daily futures trading often exceeds available silver by hundreds of times. Historically, precious metals bull markets start with gold, driven by fear of currency debasement. As gold prices rise, mining stocks follow, and eventually, silver takes the lead. Silver's lower price point, higher volatility, and small market size mean that when momentum shifts, prices can move sharply. Winners in this scenario include physical silver holders, futures traders, producers, and royalty companies. But there's a shortage of quality silver equities, as many large miners focus more on gold. Top silver names like Hecla and First Majestic still exist, along with promising juniors in Mexico and South America, but opportunities are limited. Rule warns of possible short-term pauses due to recession fears or industrial demand shifts, but the long-term fundamentals remain bullish. With expanding industrial uses, from solar panels to electric vehicles, and tightening supply, silver is positioned for strong gains. If history repeats, the move could be swift and dramatic. Silver is no longer just riding in gold's shadow. It's becoming a star in its own right. The question now is who will be positioned before the next major breakout.
In my experience, Jeremy, precious metals bull markets are led by gold. They're led by the fear buyer. They get kicked off because savers and investors are concerned about the deterioration of the purchasing power of domestic currencies, fiat currencies, in regular savings products. Gold moves first. When the move in gold allows producer margins to expand, the senior gold stocks move next, which is what we've just seen.
Mhm.
At some point in time, the momentum in both gold and gold stocks attracts the generalist investor into the precious metal space. When that happens, perhaps because of its lower unit cost, leadership goes from gold to silver. I've watched this happen 3 times before in my life, and Jeremy, believe me, you will not need Rick Rule to tell you when it occurs.
Mhm.
Silver is incredibly volatile, both to the upside and the downside. It's the upside that comes next. Uh, as to a squeeze, I think the squeeze comes about, if it comes about, because the trading volume in the futures market is so extraordinary relative to the amount of gold available for good delivery in the physicals market. Many days, single days, the trading market trades 200 times the amount of silver
Mhm.
available for good delivery on the market. The potential for a fairly small number of the futures contracts to hold for delivery and the impact of what that would have on physically available supply could be dramatic. We need to differentiate between the squeeze that we'll likely see and the squeeze we won't see.
Yeah.
There are some silver bugs who suggest that there will be no silver available, and as a consequence of that, there will be the mother of all short squeezes on the futures market. That won't happen. Silver futures markets are owned and made by the dealers, by the banks. What will happen in the event that there is a temporary unavailable of metal is that the markets will suspend the contracts and cash settle. That's what will happen.
Mhm.
This will be extremely pleasant for the people who are long and extremely unpleasant for the people who are short. But it won't be the sort of incurable market imbalance that many of the silver bulls dare dream for. The physical holder probably in percentage-wise benefits the least. The leveraged futures holder maybe more. The silver producer a lot. But the answer to that is yes, yes, and yes. And of course, the penalty is borne by those who didn't participate or heaven help them, those who were. There is a real shortage of decent quality silver companies, and that's been noted in three prior bull markets. My friend Doug Casey described the circumstance where the generalist investor money comes in the silver equity space as trying to siphon Hoover Dam through a garden hose. There just aren't enough. And the big silver names are becoming less silver-centric. The go-to name in the last bull market was, of course, Ross Beatty's entry, Silver Standard, where over 50% of revenues are now gold revenues. There is still a silver constituency. For those people who would like equity vehicles that are very responsive to the silver price, traditionally those include Core Mining, Hecla, and First Majestic Silver. For people who want really high quality silver names that are maybe less correlated to the silver market, one likely needs to look south of the border. One looks to Fresnillo, one looks to Peñoles, one looks to Buenaventura. Among the juniors, we had a great list at the conference. We had Aya Gold and Silver, a great small producer. We had Vizsla Silver, we had Abra Silver, very, very, very small, but list of very high quality discoveries. Yes and yes. People's time frame with regards to a coiled spring is painfully short for them. We could easily be in a 12 to 24 month pause. I think people need to understand that there's a lot of nervousness about a recession. And you can have production tightness in electricity if you have demand weakness in electricity without moving the price. And I think we're seeing this. Longer term, I think that uranium is a total coiled spring. What's important about the uranium equities, and we've talked about this on Kitco before, is increasing prevalence of a term market in uranium rather than a spot market of uranium, so that producers can lock in volume and price for as much as 30 years in the future, which should, over the next 5 years, lower the cost of capital, both debt capital and equity capital. And I don't think one person in 1,000 who is a uranium speculator understands the importance of the term market in uranium. And while we're on the topic of uranium, the quarter that was just released by Cameco rivals the Newmont quarter. It was a truly spectacular quarter. A quarter that had a lot of things to look at. Great free cash flow, despite the fact that Cameco's average selling price for the quarter was $57 in the spot market where the price exceeded $70. Well, that means that the short-term contracts roll over in favor of longer-term contracts. There's as much as $20 or $25 in gross selling price. No one knows how much margin. But the second thing it shows is that, at least so far, Cameco has managed the Westinghouse acquisition well, because the contribution of the Westinghouse assets into the Cameco income statement were spectacular. My nervousness about Cameco was always, could they, as miners, manage an engineering, processing, and construction firm? The last 3 quarters would suggest that the answer to that is a resounding yes.
Recent market trends are showing a powerful resurgence of investor interest in the precious metals sector, especially in gold mining stocks, which are finally catching up to the strong gold price gains that began in 2023. Rick Rule notes that while gold prices rose sharply last year, driven in large part by heavy buying from foreign central banks, this demand didn't immediately boost the valuations of gold mining companies. At first, the gap between the price of the metal and the performance of the miners remained wide. But in 2024 and into 2025, that gap has narrowed significantly as mining shares have surged in line with improved market sentiment. Major producers such as Wheaton Precious Metals and Agnico Eagle have delivered exceptional results, with share prices climbing between 100% and 150% over the past 18 months. This rally reflects more than just rising gold prices. It signals a broader market realization that the current precious metals bull market is well underway, extending across the entire mining sector. Investor confidence has returned, and participation from both institutional and retail investors has strengthened. According to Rule, this shift is fueled not only by higher commodity prices, but also by meaningful operational and strategic improvements within the mining companies themselves. Many top-tier producers have adopted disciplined capital management, restructured their asset portfolios, and focused resources on their most profitable, high-quality projects. A prime example is Newmont, which recently exceeded earnings expectations after selling off lower-tier assets and redirecting capital toward its best-performing Tier 1 operations. This move not only increased operational efficiency, but also added nearly $5 billion in cash to the balance sheet, strengthening its financial position and flexibility. With stronger fundamentals, rising valuations, and a wave of renewed investor interest, the stage is now set for an increase in merger and acquisition activity. Higher share prices give these companies greater purchasing power, while strong cash reserves allow for strategic expansion and industry consolidation. If current trends continue, the precious metals sector could be entering a sustained phase of profitability and growth, offering significant opportunities for well-positioned miners and investors alike.
I don't think that's true, but I think more confidence. You'll remember back in 2023 when Kitco viewers were experiencing frustration given that the gold price was up, but the gold mining shares weren't up. That was easy to explain in two fashions. One, the gold price was up because foreign central banks were buying gold and they weren't buying gold shares. So an asset class that had a bid was going up, while one that didn't have a bid was going down. In past bull markets, it has taken a while for the increase in the gold price to follow through to generate increased free cash flow among the gold miners. And that happened in 2024 in spades, and it's happening in 2025 in spades. What that means is that the prices of the gold miners, as an example, Wheaton Precious Metals, who was an exhibitor, Agnico Eagle, who was an exhibitor, those companies are up in the last 18 months uniformly 100 to 150%. And it's follow through, I think, gold to the gold shares that attracted our attendees. The thesis is proven. They don't now have to feel like they have to wait for a gold bull market. They understand that they're in a precious metals bull market and that they're in it right now. I think that's true. And you mentioned the Newmont quarter. I mean, that blew out everybody's earnings estimates, including my own. And frankly, it blew out Newmont's own estimates. What Newmont did, and we talked about this, Jeremy, you and I, a year ago. Newmont had, prior to this quarter, 8 bad quarters in terms of sustaining cost performance. What Newmont did is they sold off virtually all of their second-tier assets, by the way, raising almost $5 billion in the process. But the other thing they did is free up management time and attention and sustaining capital to focus on their Tier 1 projects. And the operating cost performance was absolutely spectacular. In addition to that, they added almost $5 billion in cash to the balance sheet. They can deploy some of this for sustaining capital, but they can also give some back to shareholders, which they've elected to do. They've decided that they're going to buy in stock, returning cash to shareholders by reducing the float. Spectacular result, and that has, that's. The wealth has been spread around. With people like Dakota, the market is looking at the Barricks of the world, at the Newmonts of the world, and saying, what are they going to do with all this money? What are they going to do with all this high share price? How are they going to maintain their growth? Maybe they're going to. I would suspect both of those. That's a great comment. For the viewers who aren't familiar with this statistic, in the period 2000 to 2010, when the gold price went up 7-fold, the free cash flow per share of the gold miners actually declined. It was a decade of ridiculous malinvestment of capital. The management teams that presided over that dismal performance, have been thanked and excused. But the institutional investors and the management teams themselves have kept the mining companies on a very tight leash with regards to capital deployment. My suspicion is that as the metrics around gold companies' valuations increase in a bull market, and as investor concern about companies' ability to maintain or grow their production increases, then you will see increased investment activity, including increased merger and acquisition activity. So I think what you describe as the calm before the storm is completely accurate, Jamie. My attendees to focus on the best names, the best of the best, the Agnicos of the world, the Francos, the Wheatons, give you surprising performance in a gold bull market with almost no operational risk. For myself, I bought those names 4 years ago and 5 years ago, so I don't have to buy them now. What I'm doing now is coming down the quality trail, looking for big single mine companies that would make attractive bolt-on acquisitions, and ones that are cheap. I need to mention too, Jeremy, that I'm much more willing than most to accept political risk.
Yeah.
So names like West African Resources in Africa, Endeavour Mining in Africa are appealing to me because I'm willing to take political risk and because they're extremely cheap by any metric. I personally, too, am going down into the exploration space because I like to be involved in markets where I don't have much company and very much competition. I wouldn't expect the bull market to expand into the exploration space per se for 18 to 24 months, but I like to be in space before the competition hits.
Gold is set for sustained strength in the months ahead, with technical analysis pointing to a strong chance of reaching the $4,000 mark in its next major upward move. Market sentiment remains firmly bullish, supported by enduring fundamentals such as persistent inflation concerns, ongoing geopolitical tensions, and central bank policies that continue to boost gold's role as a safe haven asset. If these conditions hold, analysts believe gold could climb even higher, potentially approaching $5,000 per ounce by January. Silver, often called gold on steroids for its sharper price swings and heavy industrial use, is also poised for substantial gains. Multiple forecasts project silver reaching the critical $50 level by early next year, a dramatic jump from current prices. This momentum is being driven by a powerful combination of factors: growing investment demand, expanding industrial consumption, and emerging technologies like solar panels and electric vehicles that are intensifying global demand for the metal. With physical supplies tightening and investor interest accelerating, silver's potential in the months ahead could rival, and in percentage terms, even outpace, that of gold. Both metals now stand at the center of a precious metals bull market that shows no sign of slowing. For investors, the message is clear. These are rare conditions that could produce some of the most significant price moves in years. The next phase could arrive quickly, rewarding those who are already positioned while catching latecomers off guard. In the world of gold and silver, history has shown that when momentum builds, it often moves faster than anyone expects, making preparation now more important than ever.